The next part of the business management topic is another key component of a business, which is the finance parts of finance now. So an introduction to finance. So the difference between accounting and finance. So accounting is a management tool that is concerned with providing information on the financial affairs of the business. So it's a way of evaluating, and we're going to look at 3 different types of financial statements that are used in accounting as part of this topic. Finance is about where the business is sourcing its finance in order to purchase all the things that it needs to purchase, and it's just the overall kind of money side of a business. But accounting is where we're going to focus, which is kind of the evaluation and the finding out the information about what the business is doing. That's the finance. So there's 3 important financial statements we're going to look at, which is the cash flow statement, the balance sheet, and the income statement. And you need to be able to understand these and possibly write these with information that you might be given about a business. So just first of all, cash flow is extremely important in a business. It's known as the lifeblood of the business. The management of cash flow is about anticipating expenditures and ensuring enough of the income is available to pay the expenditures. Some money for contingencies is also needed to be put aside. So cash flow is about having enough money to be able to pay the debts so that you don't fall into arrears with any of your creditors or people that you owe to. So with finance, we have talked about this before, but the main way that a business can fund projects or buy assets is either through debt, through buying, through borrowing money from a bank or something like that, or through asset finance, which is when an owner will put in money to buy something. So that's for asset finance. Okay. Now you can also use monies from the profit of the business. You can reinvest that profit into the business and use that money as well. But we've got debt finance, which is borrowed money. Asset finance, which is when the owner puts in money to buy something. So financial statements summarize transactions that occur over time. They are crucial for allowing external stakeholders to understand the financial viability of a business. So there's 3 financial statements, as I said, that we will look at in this topic. And these are very important for understanding how the business is going and for external stakeholders. So as you can see, we're going to be looking at 3 types of statements. One is the cash flow statement, which indicates the movement of cash receipts and cash payments. Income statements, which show the revenue earned and expenses incurred, and balance sheets, which represent the assets and liabilities of business. So these are 3 important financial statements we're going to look at. Okay, so the first financial statement is called the cash flow statement. So you can see in this diagram here, we've got cash inflows, which are like cash sales, credit sales when paid, other types of income like interest from investments and non-operating income. And then we have the cash outflows, so things that you have to pay or debts kind of. So we pay for stock, pay for expenses like insurance and wages, and we pay for non-operating expenses. So a cash flow statement shows the liquidity of a business. So the liquidity of a business is if the business has enough money that it can access to pay its debts. It helps stakeholders to understand if the business has enough money to pay its debts. This is known as liquidity. If a business does not have enough money to pay its debts, it is known to be insolvent and will go into liquidation. So that means that a company will take over the business to try and find money to pay all its debtors. So it will not be liquid anymore, or there'll be no liquidity. Cash flow statements summarize the transactions that have happened over a period of time. It's often over a month. So a cash flow statement has inflows, which is money into the business, and outflows, which is money out of the business. Okay, so a cash flow statement's not too difficult to understand. So let's just have a look at this picture at the side here. So you'll see at the top it says cash at the beginning of the year. It actually should say cash at the beginning of the month, because this is a monthly cash flow statement. You can do yearly ones as well, but this one particularly is monthly. So at the beginning there, you can see that it says 15,500 is there at the beginning of the month. Okay, so we've got that there in the business. Now, Cash inflows, we can see that sales, so retail sales, we got $20,000. Public sales, we got $33,000. Now, there's also an A, B, and a C there, which is types of cash inflows. It doesn't tell us kind of exactly what they are, but they are cash inflows as well. So the total inflows add up to $4.7 million. So we've got $4.7 million that's come into the business. So we can see there that all the inflows are there, and then we've got a total inflow at the bottom there in bold. Then we've got a heading cash outflows, and then we can see that we've had cash outflows. So for buying raw materials was $3.65 million. Service cost was $23,000. Leases, so we had to lease the forklift, which was $11,000, and leases of equipment was $125,000, and then the wages for this month were $850,000, and then there was an other expense worth $34,000. So total outflows of $4.693 million. So if we compare the inflows of $4.7 million and the outflows of $4.693, we have a surplus. So we have leftover money of $10,500. That's where it says there. So you can see we've got the total outflows, 4.6. Then we've got cash surplus or deficit, so whether we made money or didn't make money. In this case, we made $10,500. We add that $10,500 to what we had at the beginning, and we get cash at the end of this month. So that should say end of month rather than end of year. The cash at the end of the month is $26,000. Okay, so that is the 1 month of how the cash flows have worked. Okay, then if we go up to February, we can see that the cash at the end of the month, $26,000, is then brought forward to the cash at the beginning of the next month. So the bottom number goes back up to the top of the next month, because that's how much we have left over at the start of the next month. And then we do the same thing again. In this case, our total inflows in February was $6.069 million, and then our total outflows were $4.9 million. So we have a surplus again of $1.093 million in that month. Okay, so then we add that $1.093 million to the top number of $26,000, which is what we have at the end of that month, and then we take it forward to March up the top. Okay, then you'll notice that in March, the total inflows are less than the total outflows, so we've ended up with a deficit. So when we don't make enough money to cover our expenses, we put it in brackets, and that's like a minus sign. Okay, so in this case, in March, we didn't make enough, so we owed $93,000. But luckily, in February, we made $1.093 million, and we brought that forward. With what we already had at the beginning of February, we brought that forward, and we had $1.119500 at the beginning of March. So once we once we get rid of that $93,000, we've still got $1.026 million left over. So we're not the cash flow. We're not in danger of becoming insolvent, because we have enough money to pay our debts. And that's how businesses work. Sometimes they'll make money in months. Sometimes their months might be a bit quieter. But as long as they've got enough money from other months to cover expenses in months where they don't make much, then everything's okay. Okay, so just a few things of the analysis of the statement over to the side here now, the writing. So note at the top of the column is money at the start of the month, then all inflows, including total inflows, then all outflows, including total outflows. Second row from the bottom is whether the cash flow for the month was a surplus or a deficit. Last row takes into consideration the surplus or deficit plus what the business had at the start of the month. Then the next month then uses this figure at the amount at the beginning of the next month. Okay, so it's not too big a cash flow statement. So the next financial statement is an income statement. So an income statement, also known as a revenue statement, profit and loss statement, or statement of financial performance, helps define the business's net profit. The income statement shows the amount of income earned, the cost of expenses incurred earning that revenue, and whether we have a profit or a loss at the end. Now let's have a look at the statement on the side here. So at the top, you can see that we have cash revenue, or revenue or income. We have the revenue. Cash sales is $215,000, and cost of goods are $90,000. So we had $215,000 come into the business, and then the cost of making those goods was $90,000. So the gross profit ends up being $125,000. So important to know. Total sales is total sales. Gross profit is when we have the total sales minus the cost of making those goods, which gives us the gross profit, and in this case it's 126,000. Then we take out other expenses that aren't completely related to making the good, but still the business has these costs or expenses. So other expenses include like wages of 38,000, lease payment of 20,000, electricity 5,500, advertising 3,550, insurance of 2,750, and interest on loan of 3,500. So they're other expenses that the business has to pay, which needs to get taken out of the amount of money that they've made in order to see if they've made a profit. So then that gives us the net profit. So once we get the gross profit, we then get rid of all the other expenses, the extra expenses, and then that gives us the net profit. So in this case, the net profit is 51,700. So we have a net profit of 51,700. So we have the sales, cost of goods to the gross profit, then we have the extra expenses, which then at the end, when we minus them all out, gives us the net profit. So there's 5 main categories: revenue, cost of goods, gross profit, expenses, and net profit. Now, the net sales equals the sales minus discounts minus returns. So that's what our net sales are. So that's what we put at the top. So the sales minus any discounts that we've had for those sales and any sales that people have returned. Okay, so that's what net sales is. Gross profit is the revenue minus cost of goods sold. Cost of goods is the opening stock purchases minus the closing stock. And net profit is the gross profit minus the expenses. Okay, now that's very important to know, but try and see if you can understand this actual statement that's on the side. So with income statements, expenses, so after the cost of goods sold, the other expenses can fit into three types of expenses. So selling expenses like commissions, salaries, wages, advertising, administrative expenses like stationery, electricity, office supplies, rent, rates, that kind of stuff, or financial expenses like interest payments, lease payments, and dividends. Okay, so they're the 3 different types of expenses that you can have that then get taken out of the gross profit to be the net profit. Now we have the last financial statement that you need to know. And this is the 3 main ones you need to know for Year 12 as well. So it's good once you've kind of got a bit of understanding of this. So balance sheets. A balance sheet provides a picture of what a business owns and what it owes. So the assets and liabilities, and how much owner's equity is in the business at a particular date. So how much the owners have put in. The main idea of the balance sheet is to monitor the debt and equity levels of a business. So equity levels are the owner's equity, or what the owners have put in. Debt is what you borrow from a bank or something like that. There are 3 parts to this. On the left is the assets, and on the right is the liabilities and equities. Assets are items of value owned by a business. Liabilities are items of debt owed, and owner's equity is the amount of money the business owes to its owners. Okay. So there's different headings in the balance sheet. So first of all, we have current assets. So current assets are assets the business will use up within 12 months. So this includes cash, accounts receivable, which is what people owe the business, which are also known as debtors, and inventories, so stock that will be sold. So current assets are those things that will be able to be turned into cash within 12 months and used. Okay, non-current assets are assets that have an expected life that's longer than 12 months. So they won't be converted to cash within the next 12 months, and that's things like buildings and furniture and stuff that's more long-term. Current liabilities are debts that are owed by the business that are expected that are needed to be paid within the next 12 months. So that's like bank overdrafts, credit cards, and accounts payable, which are those that the business owes money to, and that they can be known as creditors. So remember, creditors are people that the business owes money to, and debtors are the people that owe the business money. Non-current liabilities are long-term debts that aren't due within 12 months but will be paid off over a long period of time, like mortgages or long-term loans and leases. Owner's equity, which is the last heading you need to know, represents the net worth of the business and can include capital, undistributed profits, and drawings. So it's what the owner has put in to the business. Okay. Okay, so here we have a balance sheet, so have a look at it here. Okay, so we've got the assets there, the current assets, so cash 4,000, accounts receivable, which is what people owe them, 6,000, prepaid expenses 6,000, and stock of 10,000. So total current assets they have are 26,000. Non-current assets such as land and buildings, fixtures and fittings make 50,000 and 10,000. Now intangibles are 44,000. Now they are things that are not you can't see and touch. So it's like the reputation of the business or the name and how much money that kind of brings to the business. So in this case, they've valued the intangibles of 44,000. So the total non-current assets is 104,000. So total currents is 26,000. Non-current is 104,000. So the total assets are 130,000. Then we go over to the right-hand side, which has got liabilities. Current liabilities, accounts payable, which is what they owe people, 550. Bank overdraft, 1,200. Credit card, 6,200. Accrued expenses, 550. Total current liabilities are 8,500. Then we have the non-current liabilities, which is how much they owe on their mortgage, which is 65,000. So total liabilities are 73,500. Then we have the owner's equity, so owner's capital, which is what they've put in, 35,000. Retained profits from the business at 21,500. Total owner's equity is 56,500, and so total liabilities and as the owner's equity put together is 130,000. And the key to a balance sheet is that the total assets need to equal the total liabilities plus owner's equity. Okay, so the bottom number of total assets, 130,000, should be the same as the total liabilities and owner's equity on the other side, which is 130,000. And the idea behind that is that when you borrow money or when you use owner's equity for something, you're buying an asset that the business will have. So they should always equal each other. That's the idea. And the idea behind looking at the balance sheet is to see how much liabilities you've got that are debt related, which are the top ones, and how much owners have put in, which is equity finance. So debt finance versus equity finance. And so once again, balance sheet, very important. Assets need to equal liabilities plus owner's equity. So they're the three types of financial statements you need to know in this topic, okay? And they're also what you will need to know next year in Year 12 under finance.